Good afternoon, everybody. We'll maybe wait a minute or so and see if we have a few more people join in the Zoom webinar this afternoon. But welcome to all of you. Glad you're here with us today to talk a little more about financial statements. All right. Well, we'll get going. If a few other people pop in, I'll try to keep a watch on the waiting room and let them in if they show up. And also, if anybody wants to jump in and chat and ask questions during the presentation, during the information, please feel free to do that. You can also put it in the chat. I'm pretty good at watching the chat, but not perfect. So, but also feel free if you have anything you want to ask about or want more clarification on or anything, just feel free to just unmute yourself and jump in as well. Since we don't have a huge group today, looks like just 5 of you. Maybe we just kind of go around the horn and everybody just kind of quickly introduce themselves. Tell us where you're at with your business. If we go around and again, tell us where you are with your business and what you're hoping to get out of this class, that would be awesome. Again, obviously, we're going to be talking about financial statements today. My name is Mark, and I am the Director of Business Coaching here at the Iowa Center. And what that basically means is I am responsible for our curriculum of classes, as well as I oversee the coaching that takes place here. We'll talk more about that um, as we progress through the class. So welcome again, and if people would like to just unmute themselves and introduce themselves, that would be wonderful.
Hi, I'm Heather Callahan, and I am have started a grant writing and nonprofit consulting business. I have 3.5 clients right now. I'm working on the fourth one right now.
Awesome.
And I find these classes extremely helpful. So thank you very much.
Well, glad you're here, Heather, and sounds like things are moving forward for you. So congratulations on that.
Thank you. Thank you.
Okay, I can call on people, but if anybody wants to jump in, I'm looking around the horn here. I've got in my upper left, I've got Victoria.
Hi. My name's Victoria. I am actually at the very beginning of everything. Starting fresh, just want to make sure that I'm doing things right while I'm starting. And it would be I would be an independent optician. I'm looking to start my own frame gallery. So
Very cool. Awesome. Well, welcome.
thank you.
Christina?
Hi, I have my little one with me right now until Dad gets home. So here he is. I live in Des Moines and am thinking about starting like a local retail business. This is my third class, and I agree that they've been very helpful. So thank you.
Great, thank you. Great, thank you. Let's see. How about Angelica?
Hi, this Angelica Jaden. I am at the very beginning as well, looking to kind of get everything planned out or whatever before I actually start anything. And what I'm gearing towards is like clothing and accessory line.
Nice, great. Liz? Okay, maybe we will, how about Leah?
Hi, everyone. I'm Leah Locke. I am actually with the Small Business Development Center. So we are also kind of a resource partner. We refer people to the Iowa Center all the time and vice versa. So I just wanted to connect This is my first class with you guys, but I'm more than happy to send people this way. So just wanted to say that I've done it before I start recommending it to folks.
Sounds good. Well, thank you for being here, Leah. Yeah, it's a great resource partner. There's a lot of great networking opportunities and other resources out there, and SBDC is great. So thank you for being here. And looks like I can't tell what the name is based on what I'm seeing on the screen, but maybe it's an initial with Lucart.
Yes, you're saying it right. I'm Nancy Lucart. I'm at Muscatine Community College. And the more I learn about financials, the better. I was, you know, that last part of your job description says, and other duties. My other duty is running a cafe. I don't even cook. But so I just want to learn how the real professionals handle small business numbers, what's important, marketing, anything I can learn, I will be a sponge.
Sounds good. Well, thank you, Nancy. And we've got at Muscatine Community College, we've got an office located on your campus there as well. So
You're right upstairs.
Yep. Sammy's a great resource as well. So yeah, make sure you reach out to her. Very good. Hey, I'm just going to share my screen with all of you, and so everybody knows there's no need to sort of furiously take notes if you don't want to. We will make these available. These PowerPoint slides will get sent to you in an email. I think it comes through Eventbrite. I think that's how you register for the class. So you'll see these emails come through, or these PowerPoint slides come through either later today or tomorrow morning. So watch for those, just so you have this resource available to you that way as well. A little bit of background, first of all, about the Iowa Center's classes, based on what some of the folks mentioned, especially, in the beginning phases, or if this is the first class you've taken. I do want everybody to know that we have a recurring number of classes, including financials. We have 6 classes, including financials, that recur on a monthly basis. And we alternate between this format on a Zoom webinar format, 1 month, and then the next month financials. So in April, financials will be in person at our office in Des Moines. So it gives people across the state opportunity to, if you're not in the metro area, to be able to participate in these classes. The other topics that we have in our Always Ready series is Always Ready Getting Ready, which is probably the first class, the most introductory class, I guess I would say. We talk about, anything as basic as, what kind of organization legally should you have? Should it be a partnership? Should it be an LLC? Should it be sole proprietorship? What are the advantages, disadvantages of each? So that's our Always Ready. Talk about insurance, talk about other compliance issues. We have a marketing class that talks about all aspects of sort of marketing introduction, from social media to more conventional, traditional forms of advertising. We have a business plan class, which will walk you through the elements of a business plan. We have a credit class. That one actually meets tomorrow here in person. So next month that will be online. Talks about what a credit score means, how your credit score is impacted, what you can do to improve a credit score. Obviously, that's very important for businesses and business owners who are looking for a loan for their business. And then we have a lending class, which basically talks about and walks you through the typical documentation that a lender would require to get a small business loan, and what sort of, different ways they would want you to sign the loan, both as your LLC, but also as an individual guarantor on the loan as well. So again, those are our classes. They recur every month. Check out our website and register for those as you see fit. And the other thing that we do offer as well is one-on-one coaching. So, if you're working on financials and you have a question, reach out to us, and we can get you in the queue for coaching. And all of those things, these monthly classes, as well as that one-on-one coaching, is free of charge. So that's what a lot of what we have going on here. We have a few other things as well, but those are the main things as far as at least relevant to this particular class today. So again, like I said, please jump in with any questions you have as we're going through this stuff. This is a little bit about our mission, the Iowa Center. We really want to empower Iowans as small business owners to improve, their financial, their create opportunities that are going to lead to financial success, financial independence, those types of things. And we believe really strongly in local businesses and small business ownership as a great economic starter for folks. So that's really what we're about. And we also have a loan fund here. So, as your business is growing and you're looking to expand and you need capital, traditional banks are great, but also the Iowa Center is a Treasury Department approved small business lender as well. So again, keep that in mind as your business is growing and expanding and scaling. So what we're going to talk about today, obviously financial statements. I want to put it in a little bit of a bigger picture context, though, to start with, before we get into a lot of the details. Financial statements are something that seem very technical to, non-business and even non-accounting people, even business people who aren't really steeped in accounting and finance. They can be a little bit intimidating. But I think we can debunk a lot of those intimidating elements pretty easily with just some vocabulary. So this is, again, a very high level kind of introduction to financial statements. Probably, 80% of what we're going to talk about here today and 80% of what makes financial statements intimidating is the lingo, it's the language. So we're going to talk about the language and debunk some of that a little bit. But before we do that, I think there's several things that financial statements help you with. Number one, whenever I certainly think about financials, one of the things I think about is income taxes. And we have to be able to, comply with, both state and federal income tax laws. And the financial statements are, basically essentially what you're filing is you're going to draw from your financial information, your financial records to be able to comply with the federal and state income tax laws. So again, that's one thing. Also, if you're looking for a loan or you want to just know how your business is doing periodically, keeping your financial statements and checking those, I always encourage people at least quarterly. I would monthly ideally, but at least quarterly, kind of running your financials for that quarter is going to be super helpful. It's going to, rather than waiting till the end of the year and being surprised by your expenses or a lack of revenue, some of those, again, terms we'll talk about today. I think, again, monthly ideally, or at least quarterly, running your financials, seeing where you're at. And then the third thing I think about with financials is putting together projections. We're going to call that budgeted financial statements. If you're thinking about starting a business or you're thinking about growing your business, you don't want to just do that, blindly, so to speak. You want to have a roadmap. You want to have made some estimates. You want to have made some budgets. So you have a good idea of, and it's not a crystal ball, it's not perfect, but you have a good idea of what your targets are, the direction you're moving toward. I've been working, just before this meeting, I had a meeting with a client I've been working with for quite a while who's looking at buying a business. And we've been spending the last couple of weeks literally pulling together projections for this business that he and his partner are thinking about purchasing. So they have an idea of what does it look like financially? How long is it going to take for this business to be able to cash flow itself? I mean, those are super important questions. We know that right out of the gate, the business is going to be, for lack of a better way to put it, is going to be losing money. Is it going to be losing money for 6 months? How much are they going to have to put back in the business to keep it cash flowed and to keep it running? So again, those projections are really important. So again, our agenda of topics with a little bit of that kind of as a preview. We're going to talk about financial statements. We're going to debunk the terminology. We're going to talk about record keeping. That's again for, your monthly and quarterly results, as well as the Internal Revenue Service. We're going to talk about budgeting. If you want to, again, develop some projections and budgets for the future. And then last, we'll talk about, again, taxes and compliance, making sure that again, we're not running into any legal trouble, so to speak, with any of the agencies that we need to be doing periodic reporting with. Right. So. All right, I'm just checking the chat here. Somebody asked a question about the recording. I don't know if, what we do is we archive the recordings on our website, so they won't come out in an email to you. But we do have this class, and I don't know how often they update them, but we do have this class as in a couple different iterations of it archived on our website. So you can go back and look at that as well. Okay, so just trying to pay attention to the chat here. What we're going to talk about when we talk about financial statements, we are going to talk about 3 of them. And these 3 statements are listed on this slide, and they are listed in the order, 2 things, the order that people talk about them most in. You most often hear people talk about a company's income statement or a P&L, a profit and loss statement. That's one of those terminology things I think people find to be intimidating, is we have a lot of synonyms. So the income statement is called the income statement. It's called the P&L. It's also called the profit and loss statement. And I think that in and of itself is a little intimidating because, if you only learn one term and then somebody one day calls it a P&L and you never heard that before, you're not familiar with it, you're like, I don't know what they're talking about. Well, you do, because it's also called, again, income statement, P&L, profit and loss statement. It's also the first statement. If we're going to prepare all 3 of these, it's the first one that needs to be prepared. So we'll talk about the income statement first, the most important one for most businesses, and it's the first one we prepare. We will then move on and talk about a balance sheet. That would be the second one we prepare. And then we will talk about a cash flow statement. And if we don't hear as much about cash flow statements, and we'll talk about why that is. But if you are going to prepare one, that would be likely the third statement that you would prepare. So again, in that order, and we'll give an example, just really simple examples for each of these, and they will all thread together. So we're going to make up a hypothetical company in the upcoming slides here, and we will, again, demonstrate each one of these financial statements. Okay, so let's first focus on that income statement, again, also called P&L, profit and loss statement. It simply records 2 things. It records revenue. Sometimes we call them sales, or we call it sales revenue. And I apologize for all the terminology. I don't make it up. It's just stuff just terms we need to be familiar with. So the sales or sales revenue is what happens when you sell your goods or services. So as it says there, revenues are amounts received from selling goods or services. So the example that we'll use here is a company that is in the business of doing landscaping, mowing grass, cutting yards and that sort of thing. So again, a company like that would earn revenue when they go out and they mow somebody's yard. They charge them $50, $100, whatever it is. And that's revenue. That's what they earn from providing that service. If they sell a good, if they sell athletic wear, or somebody mentioned that they're looking at selling, different types of apparel, the revenue would be earned every time you sell, a pair of pants or a shirt or a sweater or a hoodie or something like that. That would be your revenue or your sales revenue. Down below that, I say not money contributed by the owner. And the only reason I put that in there is because I've had a few clients come to me and they said, oh, I had $5,000 of revenue. And then I asked some questions about it. We find out that the $5,000 of revenue was $5,000 that they contributed of their own money to the business to get it started. That's not revenue. We're going to talk about that later. That's called an owner's contribution, or called owner's capital. Okay. So the only way a business earns revenue is by selling its goods or services outside the business to somebody outside the business. The other item that's included in an income statement is expense, or our expenses. And these are the costs to run the business. So again, for that landscaping company, typical expenses would be the wages they pay to their people who are mowing the grass or trimming are doing the trimming, are are installing shrubs and flowers and those things, that would, payroll would be an expense. Clearly, a company like that would have insurance in case anybody's injured. They would have gasoline for, for operating their mowers. So again, those are sort of the expenses that they incur to run the business. And the difference between those two is called a profit. Hopefully, if you don't have as much revenue as expenses, then you have a loss. But hopefully a profit or net income. So that's it. Again, income statement sounds very intimidating. It literally records or reports two things: your revenues or sales from selling your goods or services, and the expenses you incurred in running the business. So here's our example that we'll use. Again, we're just going to keep it super simple. And we are a brand new business. That's going to simplify things a little bit. We're a brand new business. We just started our business in the month of, we'll say it's February, maybe a little unrealistic for a lawn care company. But we started our business in February, and during the month of February, we earned $5,000 of revenue from cutting grass, or if we're all in Iowa and we remember last week, I guess it could be $5,000 for shoveling or pushing snow when we have one of those snowstorms. So $5,000 is what we earned from providing services to our customers during the month of February. And we had $3,000 of expenses. Now, obviously, there'd be more detail with both of these, but for example, the $3,000 consisted of wages paid to our workers, insurance for the month, fuel for the month, both for our trucks and for our lawn mowers. So our income statement is going to look like this. And it does not need to be anything fancy. You don't have to have QuickBooks is a great resource to use if you have a lot of transactions to keep track of. But if you don't, I am a big advocate of, using Excel spreadsheets. I have a revenue spreadsheet when I work with businesses, and I have an expense spreadsheet, and I literally keep track of this stuff on those spreadsheets. And then once a month, I pull it together in an income statement. And I just say, hey, what did the month of February look like? And so for this company, they had a profit for their first month of February of $2,000. Okay. And this is telling a story about the business. If I look at this, I say, oh gosh, yeah, they had revenue from doing whatever they do. They had some expenses. For a brand new business, this looks pretty good. They were actually able to earn more than what they spent during the month. So there's our income statement, as simple as that. There could be one transaction that goes into it. There could be dozens and dozens, depending on the size of the business. So again, I'll pause, see if there's any questions. Feel free to unmute and or put anything in the chat that you'd like to. Okay, so a little summary of this income statement. First, it says, where does the business get this information from? And for historical, that's what we call the past, right? Reporting on the past, the information probably comes quite honestly from your business bank statement or from your business credit card. And if any of you have attended, and I know a couple of you have, I recognize a few names, have attended our Always Ready class, one of the things you've heard me just harp on, probably to the point of making you all a little bit tired of hearing me, you got to have a separate bank account for your business. Please don't use your personal bank account to pay for business items. Please don't use your personal bank account to take collections from your business. Keep it separate, please. It's necessary legally to make sure that you're not liable for the business, but it's also going to make your life a lot easier when every month or every quarter you go to pull your information together and look at how you're doing. If you've got grocery bills or personal credit cards being paid out of your bank account, and you're also paying for business expenses and the gasoline for your landscaping company out of your personal account, it is going to be really, really hard to then separate the stuff. So please, set up a separate business bank account. And please also, you don't have to have a business credit card, but use one of your credit cards solely for the business and nothing else. Again, that's going to make life a lot easier. And if somebody calls something into question at some point, if you look for a business loan at some point, it's going to be a lot easier and a lot more likely that you're going to be successful in getting that business loan and being able to show the real business transactions if you've kept things separately. So that's where the historical information is going to come from: business bank account, business credit card. And if you're looking at the future and preparing a budget, obviously that's going to come from market research, looking at different, demographic data that would affect your business. We can talk a little bit more about that at the end. And also that's going to tie into our marketing class as well when we talk about market research and that. But that's where the budgeted or the forward-looking information will come from. Okay. So in summary, that's our income statement: revenues minus expenses. The second statement that we talk about and hear about is the balance sheet. Now, the balance sheet's a little bit different in the sense that the balance sheet is not for the month of February, for example. The balance sheet is at a point in time. So our balance sheet, we would prepare a balance sheet for usually the last day of the month, and it would be labeled AT. In other words, it would be a balance sheet, if I'm remembering correctly, February has 28 days in it, so it would be a balance sheet at February 28th, 2025. Okay, so again, balance sheet is at a point in time, because what we're going to find out is the balance sheet is always moving around. Every transaction that the business has causes the balance sheet to change. So the best we can do, I analogize it to a snapshot, like a still photo. A balance sheet is a picture of a business at a moment in time, at a point in time. So we'll see this again in our example in a few minutes, but let's talk about the items that are on a balance sheet. Again, this is debunking all the terminology. One thing that's going to show up on a balance sheet are assets, which is a fancy name for all the stuff the business owns. Items owned by the business. A few examples of assets: obviously your cash in your business bank account. That is absolutely an asset of your business. Another asset would be if you owned any equipment, if you owned a building, those would all be assets, things that you own or the business owns. Liabilities, a fancy name for amounts you owe. If you have a credit card balance at a point in time, that's going to be a liability. So again, you got a business credit card, and at the end of February, your balance on your credit card is $500 because of the fuel you bought or other things, that you're going to have $500 of liabilities. If you take out a bank loan, that bank loan is going to be a liability. Okay. The difference between your assets and your liabilities is what we call the equity or the owner's equity. Okay. And that's one of the reasons, if we go back to the first slide, that's one of the reasons why we start businesses, is because we are trying, as the owners of the business, we're taking a risk starting a business, but we're also trying to gain wealth, gain capital. And that's the equity. It's our share, as the owner, it's our share of the business. Okay. So let's talk about the balance sheet. So the balance sheet is going to have assets, and the assets that we have are going to be $2,000 from running the business for the month of February. Remember that $2,000 of net income? Well, that belongs to the business or is on the balance sheet. Okay. Also, we hadn't mentioned this yet, but I'm telling you about it now. Also, the owner, to get this business up and running, they invested $5,000 of their own money into the business. This is pretty typical. And if you go to a bank, that's one of the questions they will ask you is, how much have you put into this business so far to get it going? They want to see that you have an interest, you have put money, you put your own resources in the business because you believe in it. Okay. And then also the business took out a loan for $10,000. Okay. So they went down to a bank and they got a business loan, or they came to the Iowa Center and they got a small business loan for $10,000. And then the last thing that the business did during the month was they bought a piece of equipment. Since it's a landscaping company, we'll call it a mower. They bought, one or two of these, nice riding zero turn mowers so they could earn revenue. So they bought a piece of equipment for $6,000. Okay. And again, where is this information going to come from? We're going to have it all there in the business bank account and the business credit card. We pull it together on February 28th, and we can now prepare our balance sheet. And here's what it looks like. At February 28th, we have cash of $11,000. Okay, now that number might not pop out to us, but we can explain it to each other based on what we know about this business. Okay, 2,000 of the cash came from selling our services. Remember the $2,000 of net income. Okay, so now we're up to 2. And then we had $5,000 that we invested in the business to get it going. So now we're up to 7. We took out a loan for $10,000. That gave us another $10,000 of cash, bringing our total cash up to, remember, 17. But then we did what? We bought a mower. We bought a piece of equipment for $6,000, and we bought it with cash. So our cash at the end of the month, and this would agree with our bank account, our cash at the end of the month is $11,000. That's an asset. That's something we own. It's probably going to change next time we do anything with the business. That's why all we can do is take a picture of the company. Again, the balance sheet is like a snapshot or a picture. The only other asset that this business owns is equipment. It's that mower that we talked about. So our total assets are $17,000. Okay. So $11,000 of cash tells a story, and $6,000 of equipment. All right, on the liability side, if you look over to the right, we have one liability. It's that bank loan that we took out, that loan from the Iowa Center that we took out for $10,000. Okay. And then owner's equity. Okay, we'll talk a little more on the next slide about owner's equity, but that is $7,000, and we can prove it out. Owner's equity comes from 2 things. Okay, it comes from the income earned by the business, because at the end of the day, who really owns the business? You do, as the owner, or you and your partners do. Okay, so the $2,000 of income, that ultimately belongs to the owners of the business. Okay, and then the $5,000 that you contributed to the business to get it going. There's your $7,000. So we have total liabilities and equity of 17,000. That's one of the reasons we call it the balance sheet, is because if we prepared it correctly, it balances. $17,000 of assets came from $17,000 of liabilities and equity. Okay, it tells a story. Okay, so if I'm looking at this balance sheet and I have a little bit of accounting and finance knowledge, I can understand a little bit about this business. Okay. So a little more about the balance sheet on this slide. And this is the owner's equity I was talking about. The owner's equity, also sometimes called owner's capital, reflects, I said 2 things. It actually 3. We only saw 2 of them. That's why I mentioned 2. But the owner's equity reflects 3 things. It reflects the owner's investment in the business. Remember how much they invested? $5,000. Plus the owner's share of the profits. Remember how much profit? $2,000. Okay. That was how we got to the 7 on the previous slide. $7,000. The thing we didn't see is if the owner took any money out of the business, we call that a draw, that would have decreased their interest in the business. Now, this owner didn't take any money out of their business because they're brand new. They don't want to be pulling money out. They want to be investing, expanding, growing their business. But if they were to take some money out of the business, that would have decreased the business's assets and would have therefore decreased the amount of equity that the owner has in the business. Okay. So that is the balance sheet. Any questions on the balance sheet? Pause here for a second. Again, a lot of terms I'm throwing at you. I know high level. I'm not expecting, you to retain all this, but it's giving you some of the nuts and bolts, I think, to be able to start understanding this stuff. And again, if you need, want to have one-on-one coaching, reach out to us. If you go to the iowacenter.org website, upper right corner, says there's a button that says classes and coaching. Click on that and you can get yourself signed up for coaching in marketing area, in the financial area, the business plan area, whatever you're looking for. All right, the third statement, this one you don't hear a ton about for a lot of businesses, but it's the cash flow statement. And what it shows is how much cash comes into the business and how much cash has left the business during a period of time. It basically, honestly, looks like if you flipped open your check register for your checking account and you actually recorded stuff like I do in my checkbook, it would basically be your check register for a period of time. Because that's where all your cash is coming from and going out of. It would literally be like that check register, that old school check register. Okay. Now, the reason we don't see or don't talk a ton about cash flow statement is because most small businesses don't sell a lot of their goods on credit. Again, one of the things we preach to our clients is, get the money in the door as quickly as possible. Even if you have to pay a credit card fee, even if you have to pay, a fee to, Shopify or one of those online platforms that businesses use to facilitate transactions, oftentimes that couple percent fee is well worth it because then you don't have to worry about chasing people around to try to get their money. You don't have to spend your own time, not just chasing around and having them not pay you, but you don't have to worry about, spending your time on that when you should be spending your time, working with your employees, working with your customers, doing some of those more productive things. So most small businesses, when they provide a service or they sell a good, they collect the money. I mean, I think about that, that clothing store we talked about earlier. One of us talked, participants talked about. You're not selling clothing to a customer and saying, pay us at the end of the month. You're selling clothing to the customer and you're taking payment at the time of the sale, right? When the person comes by who cuts my grass, I'm literally Venmoing them when they cut the grass. Okay. And that's ideal. That's really good for a small business person. I don't want them to have to hassle around with sending me an invoice and trying to in the third and the second and a third invoice and trying to get the money out of me. We want them to be able to continue cutting grass, not have to chase people around. So again, cash received, any cash received, any cash paid during the period for bills or anything else. That's what the cash flow statement's going to look like. Okay. So here we go. This is our cash flow statement. Pretty straightforward. Think about how much cash we collected during the month of February. We collected $5,000 of cash from customers. Remember those, those lawns that we cut and we charged the customers $5,000 of revenue. Okay. We had $5,000 of cash coming in from the owner when they made that investment. And then we also had $10,000 of cash coming into the business during the month from the loan, right? When the bank funded the loan or they made that transfer into our bank account, that was $10,000 of cash in. During the month, we also had some cash outflows. And one of the cash outflows for the month was the $3,000 that we paid for gasoline, the money that we paid for our workers, the money we paid for insurance for the month of February. So we had $3,000 of cash payments for expenses. And then we also bought that lawnmower, that piece of equipment we talked about. and that used cash. So obviously, cash in totals up to 20, 5, 5, and 10. Cash out totals up to 9, 3 plus 6. And here you go. This is our cash flow statement. Cash collected 20, cash paid 9. The difference between those two is a positive $11,000. Okay. Now, the rest of it might look a little bit strange, but if you recall, we said this is a brand new business. So the company had no money to start with. They opened their checking account this month. So their beginning cash balance on Feb 1 was 0. Okay. So therefore, their ending cash balance is $11,000. Remember our balance sheet? Right. If we back all the way up to our balance sheet, what do we show on our balance sheet? $11,000 of cash. That obviously is the same $11,000 of cash we see right there. So if we did this statement for the month of March, we would have beginning cash on March 1 of $11,000, and then we would start over again. And we'd say, well, how much money came in during March? How much money did we pay out during March? And that's going to be our change in cash for March. And we'll keep moving forward. All right. So that is the cash flow statement. A couple things, I've already mentioned several of these, though, about the cash flow statement. As we said, for many small businesses, cash flow and net income are pretty similar. That's going to be especially true if most of your sales are cash sales. Again, with the clothing store, we're not telling customers to pay up that they can have a month or two to pay us. We're saying, you want to buy the hoodie today? Pay us the $75 for the hoodie today, right? We're not selling things on credit. We're making cash sales. Same thing on the purchases side. If we are, paying for most of our stuff when we use it, which is true again for most small businesses, then that's going to be pretty similar as well. The one place, this is the last bullet, the one place where we do run into some differences in certain kinds of businesses are businesses that carry inventory. Okay. I think about this, that would be true for the clothing store. You may make a lot of cash sales, but the issue with that from a cash flow point of view with a clothing company, for example, is you're buying your clothing today. That takes cash today, but you're not selling it until the future. So I would encourage a business that carries inventory to prepare a cash flow statement, because again, the cash flow gets into timing issues, right? If you're having to buy inventory today, but you're not selling it until April or May, that can cause, you've probably heard this term before, that can cause a real cash crunch or a liquidity problem. Okay. So, yeah, that's one kind of business, again, where you're carrying inventory. I would encourage, and we can have more of a discussion about that, but I'd encourage the preparation of a cash flow statement. Okay. All right, budgeting. We mentioned this briefly earlier. Historical information is important. We absolutely have to prepare information about the past so we can fill out our taxes, so we know how we've done, during the previous quarter, during the previous month. But it might also be helpful, and it is helpful for most small businesses to prepare projections or budgets. Again, terminology, I know it's a little daunting, but budgets, projections, okay, and pro formas, those are all terms that I hear used somewhat frequently. They refer to the same thing. So budgeted financial statements, pro forma financial statements, projected financial statements. This is not looking at the past. This is looking at the future and saying, what do we think is going to happen? How many hoodies do we think we're going to sell in the upcoming month? And how much will each of those hoodies cost? And how much is our electricity bill going to be in the future month? And how much is our payroll going to be in the future month? How much is our rent going to be? So again, these projections are really helpful to prepare. A couple reasons why. I'm going to actually start with the last one because I think that's as good a reason as any. You're going to run your business a heck of a lot better if you have an idea of, you know, where you think you're going, where you think you're going to be spending your money. So again, I would prepare projected information. If you go to get a loan, if you've been in business for less than 2 years, the Iowa Center, my loan team here is going to want to see budgeted information about your business. If you've been in business for more than 2 years, they may or may not ask for budgeted information if there's enough historical stuff that they can look at to make a decision. And also, one of the components of a lot of business plans are budgeted financial information. So again, a lot of reasons to prepare budgets. I think probably the most important reason for me is good management. You know, good fiscal management, a good roadmap, not just, again, sort of operating blindly. Okay. When I work with clients to prepare budgets, I always start with expenses. It may seem a little strange, but I start with expenses, partly because expenses are a little easier. You know what, you have a good idea what your rent's going to be. So again, I talked earlier in this session about one of my clients who's looking at buying a business. We started with the expenses. We started with payroll. Then we started with, IT. He's going to have to hire some IT. He's going to have to hire a marketing firm. He's going to have to hire, an accountant, not as an employee, but an accountant as an independent contractor to help with keeping the records for the new business. So we started on the expense side. He got an estimate for rent. He got an estimate for insurance. So we started with expenses. Okay. And then we moved on to revenue and we said, all right, how many, again, if you're a clothing company, how many hoodies do we think we're going to sell each month? How much do we think we're going to be able to charge for those hoodies? Okay. And I really like to break this down in as much detail as possible. So again, if I'm a clothing company, I'm not just saying how many clothes am I going to sell. I'm really looking at it by different product lines, different types of clothing. Um, it's going to give you more information. Like that landscaping company we talked about. I'd want to know how much revenue I want to project revenue for cutting grass. I'd want to project revenue for fall cleanups. I'd want to project revenue for, installing, bushes and shrubs and trees, all of those different things. Again, a lot of landscaping companies will push snow during the winter. So I'd want to have a budgeted number, a projected number for revenue from snow removal. Okay, again, I think the more detail you have, the better. Okay. A little bit of repetition here, but a few additional ideas on budgeting. It's that roadmap, that's that management piece we talked about that I think is so important. If you do have a roadmap, it makes it a lot easier to avoid problems. If we see a problem on the horizon, a lot easier to deal with it ahead of time than having to react to it again in kind of a, oh my gosh sort of way. It's going to allow us to determine after the fact, I always like to look at my budget for a month at the end of the month and say, all right, here's what actually happened for February. What did I think was going to happen? How does my budget for February differ from my actual for February? That's going to tell me a lot. That's going to tell me areas where maybe I've missed opportunities. It's going to tell me areas where maybe I've fallen short. And again, it's gonna really be helpful in that way. Also, we deal with clients sometimes that bid jobs, that have to bid things, and a bid is almost like a mini budget. Like you're gonna bid the job. Well, that's really a budget. How can you bid a job if you can't pull a budget together? So just some additional, hopefully helpful information about budgets. I already said everything on this slide I preached about. I preached about it in our Always Ready, Getting Ready class. Please keep separate business bank accounts for your business. Please have a separate credit card you use solely for the business. It's going to make it so much easier, and it's going to make it much more likely you don't run into legal problems as well. So let's see. Make sure I didn't miss a slide here. Yep, good. Taxes and compliance. One thing, if you're selling goods in Iowa, basically all goods are taxed, sales tax that is. And some services are taxed. So I've got a link here for taxable services. And one of the things I've seen in the last 2 years is the state of Iowa has added more services as taxable. My guess is it's like any government agency, they're wanting to get more tax revenue to operate the government. So we're seeing more and more taxable services show up. So make sure that, again, if you're selling goods, you've got an Iowa sales tax ID number. I've got a link for that on, I think, on the next slide. And then even if you're doing services, make sure that if you're not collecting tax on those services, that those services truly are not subject to sales tax. Okay. And this is the first hyperlink on this slide is to get your sales tax ID number. And the second link is to get an EIN. It's an employer identification number. If you did the Always Ready class with us, we talked more in depth about that. But that's basically a Social Security card, a Social Security number for your business. That's the number that you file your federal taxes and state taxes under. So again, sales tax ID number is just for sales tax purposes in the state of Iowa. Your EIN is a federal number. And again, it's like your Social Security number for a business. Okay. And then I think the last piece is federal taxes. We talked a little bit about that. Most small businesses would fill out a Schedule C, is what it's called, the letter C. And it looks a lot like an income statement. It has revenues, expenses, and therefore it has income from the business. And I've got a link to the Schedule C here. Obviously, there's more boxes and details on it, but from a big picture point of view, that's all it is. It would be, here's your revenue from cutting grass, here's your payroll expense, here's your gasoline expense, here's your mileage expense, and then the difference between those two will be your income that you have to pay taxes on. So again, I've got a hyperlink just so we can see what that 1040 Schedule C looks like. So that's what I have for today. Happy to take any questions. I'm not seeing anything in the chat right now, but that's overview of financials. I know that's a lot of information, a lot of terminology. And again, the best thing to do to learn this stuff is, start doing it. So I'll hold on the Zoom for a few minutes here and see if there's any other questions. But like I said, watch for an email with these slides attached to it. And if you have any questions, reach out to us, the iowacenter.org. That's the THE iowacenter.org. All right. Thank you all for taking the time this afternoon, and I appreciate it.